These are the top 7 stocks to buy in 2020. I have done endless research on these companies, so be sure to watch all the way until the end to get my full analysis. But before we get into that, my name is Zach. Don't forget to hit the like button on the video, subscribe with the notification bell, and hit all my affiliate links in the description below so I make more money. I can't do that. I can't intro like that. I can't do it like every other YouTuber. I can't just, hey guys. All right, whatever. Just like the video if you enjoy this type of video, if it helps you out, if you want to see more content like this, so I know to make more stock market videos instead of just stimulus checks. So without wasting any more time, let's get right into it. The first stock that I'm looking at that I've done endless research on is Parker Hannifin. This is a manufacturing company. I'm gonna turn the screen recorder on right now, actually. Let's do that. Before I go into the analysis, I don't want anyone watching to feel intimidated. You don't have to be an accountant. You don't have to have any finance background to understand how to analyze a company. It's actually very, very simple. It's very easy. I'm going to explain it in as much layman's terms as possible. I'm not gonna just sit here and say, oh yeah, you know, the PE ratio, blah, blah, blah. I'm gonna explain to you what everything I say means. So if you're watching this, please stick with me. If you have any questions alongside this entire video, drop a comment below. I will respond to you, or someone in the community will. There's a lot of great people here that help each other out. Let's just get right into it. So the first thing I would look at is their website. Go down here to their investing section. You can look at their about page if you want to know more about the company. This is a manufacturing company. They build things from medical devices all the way to airplane parts. They're in the industrial sector. So basically they're a cyclical company, which means they tend to go up when the market's doing well and there's a lot of business going on, and they tend to go down when there's not a lot of business going around because they're a B2B business. So when businesses are booming and they need more parts, they need more things made for them, manufactured, they go to Parker. But when there's less business going around and the economy is shrinking, Parker tends to shrink too because there's less business for them to do. So scroll down here on their tab, you can see Parker has increased its annual dividend paid to shareholders for 63 consecutive years. If you don't already know what a dividend is, it's money that a company pays you for being a shareholder every single year, whether it's quarterly, semi-annually, or monthly. They pay you money for being a shareholder. In general, I like companies that are dividend aristocrats. A dividend aristocrat is a company that has been paying a dividend for 25 years or more and increases it every single year. When we go to their financials, I like using seekingalpha.com. You can use Yahoo Finance. You can use any other type of finance website. I personally prefer Seeking Alpha. It's very easy to use. You go right here, search for a symbol. So right here, we're already on Parker Hannifin, but I'll just show you. Their ticker symbol is PH. I just click on it. It takes you right here to the summary. And the first thing I look at is their PE ratio. Now, you might have heard PE ratio before and you don't know what it means. It is the price to earnings ratio. So a PE ratio of 16, you are paying 16 times more for the stock than their earnings. In general, you want the PE ratio to be lower. The lower the PE, usually the better. If it's too low, if it's like 3 or 4, something ridiculous, then something's going on with the company. They're almost going bankrupt. And if it's too high, well, the company's very expensive. Right now, the S&P 500 general PE is around a 23. So seeing this at a 16 is pretty good. But then again, you always want to compare the PE ratio of a company to other companies within the same industry. So if you're looking at McDonald's, compare it to Jack in the Box stock and look at that PE ratio, right? You want to compare in the same industry. The next thing I like to look at is their balance sheet. Very easy. A balance sheet is just a paper saying this is how much we got in assets, things that we own, things that we can sell for money, and this is how much we got in liabilities, things that we owe, debts we need to pay, and the rest is equity. Equity is just the value, the difference between the assets and the liability. This is what the company's value comes down to. So I like to go straight to overview because it's a simple condensed version of what I'm trying to look for. Scroll down to balance sheet. TTM just means trailing 12 months, and look at the current ratio. This tells me how liquid the company is. I always want this to be above 1 because that basically means you take their current assets and their current liabilities, and they have 1.49 more in assets than they do in liabilities. If they needed to pay off their debts right now, they absolutely can, and that is very important. The next piece of information you want to look for is their revenue. So right here we can see in 2015, they made 12.7 billion in revenue. This is how much money they've sold. This is not their net income. This is their revenue. We'll get into that in a bit. So seeing that on 2015, they sold $12.7 billion worth of sales. It has trended upwards all the way to 14.3 billion, which is good trajectory in my opinion. Seeing it go upwards, seeing it grow is a positive thing. You want to see that. You never want to see it go down, and you don't really want it sideways. It depends on what you're investing in, but for the most part, revenue trending up is a good sign. So once you see that revenue is trending up, the next thing I'll look for is typically their net income. I just want to see how profitable they are. What are they doing with their money? So their net income has been relatively steady. It's gone from a $1 billion in net income to $1.5 billion. And net income can get tricky because there's a lot of reasons why the number shows up as it is. There could be a lot of reinvesting. They could be putting money into research and development. So the next thing I'll look at is their dividend, which is very important to me because I am a dividend investor. I like dividend stocks, although there are some stocks on this list that are not dividend payers, which we'll get into. So a dividend yield of 2.19%, not the greatest. I like 3% or more. But when you look at their dividend history, you could see that it's just increasing over time. If we go to their all-time, since 1989, I think, no, definitely way before that, it just doesn't show it on Seeking Alpha, they've been consistently raising that dividend. You can see the amounts, the exact dates of how much was paid out. Go to their dividend growth and look at their compound annual growth rate as soon as it loads up. Their 10-year growth rate, 13%. So the way you make more money with dividend investing is either you buy more shares to collect more dividend, or you reinvest the dividends that it pays out, or just by holding the stock, the company itself will start raising the dividend it pays out and you make more per share that you already own. But overall, this dividend scorecard tab is probably the best tab when you're looking at the dividend, just to get a quick glance. 2% dividend yield, a 36% payout ratio. Now, a payout ratio, think of it like the health bar of a company, right? But in reverse. The lower the payout ratio, the better, because that is how much of their earnings they're paying out back to the shareholders in dividend payments. You never want it to be too high because it means it's unsustainable. And when it gets above 100%, that usually means they're taking on debt to pay the dividend, which is why I didn't like Boeing before this entire global crisis went on 6 months ago. I didn't like Boeing because their payout ratio was above 100%. They are taking on debt just to maintain their dividend payout. And look what happened now. The dividend is gone. It's been suspended. So the second stock is Facebook, and Facebook does not need an introduction. I've done a lot of videos on it in the past. I might link them somewhere below. But basically, we know what Facebook does. Social media company. They own WhatsApp. They own Instagram. They are growing every single year. And the first thing I look at with Facebook is their revenue, because this is a pure growth company. They don't pay a dividend. So what really matters most is that the company is growing, and it's growing at a fast rate. So we can look here, December 2015, $17.9 billion in revenue. 2016, $27.6 billion in revenue. 2017, $40.6 billion in revenue. 2018, $55.8 billion, and finally now we're at $70.6 billion as of December 2019, and it'll be exciting to see what they put out in 2020, especially with this whole situation. But we do know there are some drawbacks. Businesses are more worried about surviving and not thriving necessarily in this environment, so they're spending less money on ads, which means less revenue for Facebook. But when we look at the earnings report, if you just go over to their monthly users, we can look at this chart. It's just straight up and to the right. It's just straight up and to the right, and it's never gone down. 2.6 billion monthly active users. Insane. That is a record for Facebook. You can see it just jumped up in Q1 of 2020, which no one really expected. And when we go to the world population, there's 7.8 billion people on the planet. And out of the 7.8, about 1/3, about 1 in every 3 people use Facebook or Instagram or WhatsApp at least once a month. And let's not forget the virtual reality that Facebook has been working on in the background, Oculus. This is a virtual world that they are creating, which is, in my opinion, definitely a big part of the future. I think VR is going to be a huge thing. It's just not very popular yet, but they are already working on that. They're spending a lot of money on research and development. We go to their financials tab. Look at their revenue at $70 billion in 2019. Go to their net income, $18.4 billion. They are spending a lot of money on infrastructure and research and development. to develop things like Oculus, virtual reality, and grow at an even faster rate. They just beat earnings by 1 cent, but everything else that they announced, that there's way more users, and that if everything gets back to normal, if you believe this global crisis is going to end soon, then Facebook should be going up a lot faster. But if this crisis keeps going on, yes, there's going to be more users, but how many businesses are going to be advertising? So that is a concern. So Facebook 200 or below, that's my buy price, and that's what I've always been buying Facebook at. 212, it's all right. It's not like you're overpaying. It's still not overvalued like other companies, in my opinion. The third stock, Tesla, the most controversial stock in the entire stock market, the most talked about, crazy stock, volatile, up, down, unpredictable. Elon Musk, let me tweet that my stock is overvalued, dropped 10%. By the way, it dropped to 700 that day. I bought a lot of shares on that day. Tesla is unpredictable, but when we look at Tesla right here, let's go to their income statement. They are growing from 4 billion in 2015 all the way to 24.5 billion in 2019. That is 5x revenue growth in 5 years. That is amazing. Tesla is putting up strong numbers. No one predicted this. And when we go down to their net income, this is why no one really likes Tesla. Their net income is negative. They are still operating at a loss. However, the earnings that just came out recently were positive. It was a positive earnings per share. Tesla shocked all of the people that predicted it would be negative. All the analysts thought it would be negative earnings per share, like negative 30 cents. It was a positive, like $1 something per share, which was amazing. Tesla put up crazy numbers, which is why it's here back up at 819. Now, I could make an entire separate video just talking about Tesla, how they're one of the most innovative companies out there. They're not just a car dealership like a lot of people think. They take things to a whole new level. Tesla has data on every car that they drive out. They have self-driving. All the data of everybody driving Teslas out there is being collected by them. When you go to buy a Tesla, you don't walk into a dealership like Ford or Honda where you walk with a dealer, deal with a salesman, and look through all the cars, and you're in a huge parking lot. You just go to the mall. I don't know if you've been to a Tesla store before, but it's like an Apple store. You just walk in, there's like 2 or 3 cars in there. You check them out, and if you want it, you just order it. It gets delivered to your house. They drop off a key. You don't even have to talk to anyone. You don't have to touch anybody. They literally contactless drop the car off to your house, and then you just come outside, get the key, and now you have your Tesla. That's an innovative way of selling a car. It's hassle-free. More and more people are starting to realize that it's actually cheaper to own a Tesla in the long run than it is to own a gas-powered vehicle. Why? Because you're not paying gas anymore, and electricity is much more cheaper and much more efficient. And as far as Tesla being competed against by other companies, no one is close to competing with them. They have a huge moat. They are way ahead of the game. They have all the data on the self-driving cars. They have all the knowledge on the battery powers, electricity. All these companies are behind them, and in the future, they are probably going to be paying Tesla to give them some battery-powered cars. And a lot of people also have the concern of, what if Elon Musk dies? What happens then? Well, Elon Musk has already somewhat laid out the plan, so even if he did pass away, unfortunately, I think the plan is still laid out for them, and they can still execute on everything that's supposed to happen. Everything that Tesla says they were going to do, they've accomplished. As far as Tesla being undervalued or overvalued, all I know is in the long run, I think Tesla will be well above what it is today. But is this the best price to buy right now? Maybe not. Maybe you can wait for a dip. Maybe it'll go back down to 500. You'll get an opportunity to scoop some up and it'll go up. Maybe it'll go to 300. Maybe it'll go to 1,000 tomorrow. If you take the classic investing approach from the intelligent investor, or you look at how Warren Buffett values companies, Tesla is not a buy for Warren Buffett. He's not buying Tesla. It's not profitable. It's barely been profitable in this first quarter. So for a lot of people, it doesn't make sense to buy Tesla. The next company is Walt Disney. They are trading at 109 a share right now. They fell all the way from the 140s before all this happened, all the way down to 85, and now they're back up to 109. I personally picked up a lot of shares around $85 a share, and I still think $90 or below, Disney is a great deal. But right now at 109, it just does not make sense to me, because we can look at all the key data right now. Like, we can look at the revenue, and Disney's numbers are amazing. Like, we'll just look at their revenue right now. It's gone from 52.4 billion in 2015 to 69.5 billion. So the revenue is increasing, everything's doing well. But that's 2019 September. I am very confident that the 2020 numbers are going to be a lot worse than 2019, because their parks are closed and their cruise lines are closed, and that is a huge part of their revenue. And I understand they have a whole media side. They have Disney Plus, which is amazing, and I'm sure that's doing very well right now because people are cooped up in their houses, probably want to watch some Disney movies. But we are still not putting in the fact that their whole parks and cruise lines are closed. I think the fact that it started bouncing back up just doesn't make sense to me. I mean, we look at the economy, the unemployment's getting worse, everything's getting worse, but the stock market's like, nah, bro, just gonna keep going up. I'm gonna do what I want. So I'm kind of seeing that with Disney. I think it's overvalued, but it is on this list because it is something to watch. I think it will drop back down below 90. That's just me speculating, because if it does, I am watching it. I will be buying a lot of Disney, especially if it goes below 80. I'll be loading up on Disney, and I've been waiting for that opportunity, but it hasn't come yet for me. You can also check out their stock price on their investor tab on their website. It's pretty cool. I mean, same thing as Seeking Alpha. But the fact that it's at 109, again, I don't understand. And their earnings did come out recently, and it was below what was expected, but it still went up because, you know, whatever. And other news though with Disney, Bob Chapek, the recent CEO, took over back in February 25th. So he came in to become the CEO, to take over before all this global crisis happened. And now all this happened to him. He's a new CEO, and the former CEO, Bob Iger, who was a beast, has decided to come back into the picture. Kind of told Bob Chapek, hey bro, sit down to the side. I'm gonna take care of this important stuff. So Bob Iger is back as the executive chairman of the Walt Disney Company. Basically, he's the boss, he's back, and he's just gonna tell Bob Chapek what to do. If you don't know who Bob Iger is, by the way, he's run Disney since 2005. He was an amazing CEO. He just released a book about a year ago called The Ride of a Lifetime. If you haven't read it already, I would definitely read it, especially if you're a Disney shareholder. So the next company is Microsoft. We all know what Microsoft is. We all know Bill Gates. This is an example of one of the most perfect balance sheets, income statements, all around financials in the entire stock market. That is Microsoft. So when we look at the first metric, the PE ratio is at a 32, which is actually really high. And it's high because everything is literally perfect. The fundamentals of the company, of what Microsoft is, what they're doing, where they're going, and their financials to back it up every single year. They have an amazing track record. Let's just look at their key data. When we scroll down to their balance sheet, look at that current ratio. It's at a 2.9. A 2.9, that is ridiculous. That means they have 2.9 more current assets than they do current liabilities. And then when we look at their financials, look at the revenue. It's gone from 93.5 billion all the way up to 125.8 billion every single year, steadily increasing. And then we drop down to their net income, 12.1 billion all the way up to 39.2 billion. That net income growth is insane. Their net income is growing faster than their revenue, which only explains one thing. They are much more efficient at lowering their expenses and increasing their overall profits. And that explains why they can afford to pay their dividend of $2, and it only affects 35% of their earnings. Their payout ratio is very low, which is a great thing. And although their dividend yield is only at 1.10%, their growth rate is at 10%, which means when you buy the stock and you have that dividend, it's going to grow very fast. And they have a dividend growth record of 16 years so far. This is a tech company that is growing fast and also paying a dividend. Now, the only drawback to Microsoft right now is they are overvalued in price, in my opinion, but they are almost always overvalued. Their PE ratio is almost always high. You could see even during this time of this crisis, right at March 20th, that was a great time to buy. Anytime you see Microsoft on sale or drop dramatically, it's usually a good buy. Right here at 137, that was a great time to buy it, and they've already pretty much recovered to before this whole thing happened, which also doesn't make sense because why are these stocks recovering when the economy just seems to be getting worse, unemployment's getting higher? That's a whole separate video, but Microsoft is just a beast of a company. Okay, so this next company is ESS, Essex Property Trust. This is my favorite real estate investment trust. They invest in the residential area. If we check out their website, they're all over California, which is where I live, so I see them everywhere. We're on their investors page. You can check out their financials. You can see their SEC filings. You could check out their annual reports. but we're not going to get into that. That's for a whole separate video. They've been compounding a 17% return since 1994 all the way through 2019, which is very impressive. They've beaten the S&P 500. They've got 25 years of increasing dividends, so they are an S&P 500 dividend aristocrat. They made it onto that list. This is where all of their locations are. So you can see some is in Seattle, 17% of their income. 42% of their income is in Northern California, and 42% is in Southern California, Ventura, LA, Orange County, San Diego. So this is how their apartment buildings look. They invest in residential real estate. They just buy up huge apartments, rent it out to everybody. Let's take a look at their financials. So with Essex Property Trust, they have a 3.3% dividend yield. It's at a 61% payout ratio. Now this is different from regular stocks. REITs generally are at 90% payout ratios, and that's because they are required by law to pay out 90% of their profits to the shareholders. So seeing it at 61% is actually kind of weird. I think it's definitely going to go back up. An 8.8% 5-year growth rate, which is pretty good. And if we go to the chart right here, since 1994, $1.68, 72, 77, 95, $2.15, $2.38, all the way up to $7.80 in 2018. And the last stock is Realty Income Corporation. This is a real estate investment trust for commercial real estate. They own things like gyms, grocery stores, and they're not residential like Essex. I also like Realty a lot. They're right up there with Essex. I like Essex just a little bit more because I prefer residential real estate. However, commercial real estate is also a really great place to be. Realty, in my opinion, is on a sale right now, anywhere around $50 or less. I see it as a good deal. Unless this global crisis gets worse, things stay shut down, if we don't see a recovery, then things are going to get real bad for Realty and even Essex, because normal people, residents of regular homes and apartments, are also not paying their rent. So it's not just commercial real estate. The residential side is also suffering. Let's check out their dividend. So their payout ratio is at 84%. That's more realistic for a real estate investment trust, at a 5% yield with a 4% growth rate with 26 years of dividend growth. Anyway, that's all the time I have now for this video. This is going to be probably one of the longest videos I've ever made. I hope you enjoyed it. If you do enjoy these type of videos, again, don't forget to drop a like and subscribe with the notification bell so you know when I release the next video. And I appreciate every single one of you watching.